Welcome back to the Deep Dive. Today we are tearing into the recent fiscal fourth quarter and full year 2025 earnings call for Embecta Corp. That's ticker EMBC.
And this one is really fascinating. It's a classic case of a company caught in a bind.
A structural vice, you could say. They're doing an amazing job on their balance sheet, hitting profit goals, but at the same time, they're facing these just brutal headwinds in their core business.
That's the core tension right there. You just read the management commentary. It's all positive, operational execution, margin expansion, great cash flow. They beat their own internal goals for the year.
But the market reaction was completely the opposite.
Completely. The stock got hammered, which tells you investors are looking past the current discipline and are way more concerned about future growth, or, the lack of it.
So our mission today is to figure out that divergence. We need to unpack why adjusted earnings beat expectations, while revenue, profoundly missed.
And we have to look at their big strategic pivot. This bet they're making on GLP-1 adjacencies and what the guidance for fiscal year 2026 really means for the business.
All right, let's start with those Q4 headlines. If you were only looking at the bottom line, it looked like a clear win.
It did.
Adjusted EPS came in at 50 cents, which comfortably beat the FactSet consensus of 46 cents. On the surface, that looks like a management team that's totally in control.
It does, but that control wasn't enough to hide the pain on the top line.
It's a revenue number.
Exactly. Q4 revenue was $264 million, and that was a miss. And the year-over-year numbers were really concerning.
How bad was it?
Revenue was down 7.7% as reported. But if you look at it on an adjusted constant currency basis, it's a very steep 10.4% decline.
Wow, a double-digit erosion in the core business. That's what the market reacted to.
That is what hit the tape the hardest. The stock was basically flat pre-market while people were digesting that EPS beat.
But then reality set in.
And the stock just dropped. It fell over 7% by the close. The market sent a very clear signal. The revenue stream is deteriorating too fast, no matter how good the cost cutting is right now.
And that brings us right back to that core tension you mentioned. It's this brilliant profit protection versus, this structural revenue erosion.
Let's start with the bull case, because their financial execution in fiscal 25 was genuinely stunning. Full year adjusted EPS was $2.95.
Which is a huge step up from $2.45 the year before.
A massive step up.
That margin improvement story is almost unbelievable for a company that's fighting this kind of volume decline. They drove their full-year adjusted EBITDA margin to 38.5%.
That's up from 31.4%, a 7 percentage point improvement in a single year.
How on earth do they do that?
It was a mix of things, really surgical cost control, some favorable product mix, and critically, managing their debt.
The balance sheet repair.
Yes. That was priority number one for them post-spinoff, and they absolutely excelled. They generated $182 million in free cash flow for the year.
And they didn't just sit on it.
No, they immediately plowed that cash into paying down $184 million of debt. That brought their net leverage down to about 2.9 times.
Getting below 3 times is a major milestone. That gives them a real safety net.
It does. And they kept their 15-cent dividend, which helps cement that story that this is a stable, cash-generating business, even if it is shrinking.
Okay, that stability is crucial. It's buying them time. But now we have to face the elephant in the room.
Where did that revenue go?
Let's break down that weakness. The U.S. market saw a punishing 15.2% decline on an adjusted constant currency basis. Was that all structural, or were there some one-off things in there?
It was a bit of both, but you can't deny the structural weakness. Management pointed to about $17 million in tough comparison factors.
Like what?
Well, $10 million was from advanced distributor orders in Q4 of 24 ahead of a port strike that never happened, and another $7 million was a timing shift from a prior quarter.
Okay, so if you strip that out, the underlying decline is still bad, but maybe not quite a full 15%.
Right. But even without those comp issues, they still had pricing pressure.
The U.S. results included a $7 million unfavorable price variance. What was that from?
And this is the key insight. It wasn't just competitors undercutting them. This was related to milestone payments made to a large U.S. pharmacy customer.
So it's basically the cost of keeping market share.
Exactly. Think of them as higher rebates. To stay on the preferred lists with major distributors, they have to give more revenue back. It's a sign that their legacy products are facing intense competition.
And that competition is even worse internationally, right? I saw they called out China specifically.
Yeah, China is driving the international decline.
Yeah.
And what we're seeing there is the clear impact of, national policy shifts.
The push for local brands.
That's the big one. And also these volume-based procurement programs. These are government tenders that just force massive immediate price cuts. For a foreign brand like Embecta, it's a real secular shift against them.
And then the product mix is just making it all worse. Pen needles, their biggest franchise, were down almost 14% globally.
And their syringe products in the U.S. are they're fighting the tide. The market is shifting from insulin vials to modern insulin pens, and that's just an ongoing decline for them.
Which brings us to the future, and probably why the market really sold off. The forward guidance?
Yes. If fiscal 25 was about cost control, fiscal 26 is where the rubber meets the road on all these risks.
So the numbers for 26 are...
Of what?
Management guided for revenue between about $1.07 and $1.09 billion.
Right, which is basically flat to slightly down on a constant currency basis.
And adjusted EPS guidance is $2.80 to $3. That flat revenue and an EPS number slightly below the street at the midpoint, it signaled the party's over for cost cutting.
And here's the real kicker, the margin warning. Adjusted operating margin is guided to between 29% and 30%.
Which is a big drop. That's about a 180 basis point decline from their great performance in 25. So what's eating into their margins after all that work?
They were very specific about it. Half of that decline, so about 90 basis points, is from expected increases in cannula cost.
The cannula being the critical metal part of the needle itself.
Exactly. And this is where the legacy of being a spinoff really hurts them. Embecta gets its entire cannula supply from its old parent company, BD.
Until when?
Until 2032. It's a long-term agreement. So they're buying a mission-critical part from a captive supplier who can essentially dictate price increases every year.
That's a terrifying single-source risk.
Yeah.
Especially when that supplier is now technically a competitor.
It gives BD massive leverage. So what's management doing about it? They're sinking R&D money into qualifying alternate suppliers.
And that explains the other half of the margin pressure.
That's the other half. It's a strategic necessity. They have to accept lower margins today to get rid of that catastrophic risk down the road. It's a painful investment, but they have to make it.
So the margin squeeze isn't a failure of efficiency. It's a forced investment in de-risking the supply chain. That's a key distinction.
Right. And meanwhile, they are still guiding for excellent cash flow. About 180 to 200 million in free cash flow for 26.
With a plan to pay down another 150 million in debt. So that balance sheet focus is still there. It's giving them the runway they need.
And they need that runway for the next part of the plan, the pivot to growth. Specifically, this GLP-1 opportunity.
The long shot. This is the market's hope for a turnaround. They're working with over 30 pharma partners to co-package their pen needles with generic GLP-1s.
And management thinks this could be at least a $100 million annual revenue opportunity.
By when?
By 2033.
2033. That's a long way away. Mm-hmm. And 100 million sounds almost cautious, given the size of the GLP-1 market.
It's very cautious, and it really highlights the uncertainty. For fiscal 26, the high end of their revenue guide only assumes new revenue, mostly from GLP-1s, adds about 100 basis points of growth.
So $10 million.
$10 million. And the low end of the guide assumes basically zero impact.
The market has to be skeptical because that revenue's so far out, and the delivery systems for these drugs are changing so fast.
That's the big risk, the structural obsolescence risk. What if the next generation of GLP-1 pens just integrates the needle system? That could make Embecta's whole co-packaging strategy obsolete before they even get there.
So let's pivot to the investor reality here. The stock is down about 40% over the last year. It's badly underperforming its peers.
The market has voted.
So you have this bull case that rests entirely on the balance sheet, right? Strong free cash flow, paying down debt, that leveraged safety net, and this GLP-1 lottery ticket.
It should create a floor for the stock price. But the bear case is all about execution risk. The market is basically saying, we believe you can cut costs, but we don't believe you can grow.
That flat revenue guide for 26 just confirms it.
It suggests they haven't stabilized the core business yet. And the consensus view is that even brilliant cost cutting can't offset accelerating volume loss forever.
But the sell-side analysts see the discount. We're seeing consensus price targets between 16 and 18.50.
Which implies huge upside, 35 to 50% if they can actually execute this turnaround. The stock is cheap, but the market wants to see proof.
All right, now for our segment. This is not financial advice. We're going to put on our hedge fund hats and pitch an outrageous but plausible trade idea based on what we've just discussed.
And our trade idea is focused squarely on that deleveraging floor. It's about using the fear and volatility in the market right now.
So what's the proposed trade?
It's a structured long position. You go long the equity, so you buy the shares. But at the same time, you sell put options 15 to 20% below the current trading price.
So you're betting that the downside is limited.
You're betting that the company's explicit promise to use its massive free cash flow to pay down debt creates a structural floor. You're selling those puts to collect premium, which lowers your cost basis on the stock you bought.
And it lets you monetize the high volatility.
Exactly, while still keeping all the upside if that multi-year GLP-1 story ever actually starts to work. It's a cash flow arbitrage bet.
To sum it all up, Embecta is in a very, very difficult transition. It spent its first few years cleaning up the balance sheet.
And now it has to shift to being a growth platform, relying on these adjacent markets like GLP-1s to save its top line, all while battling its own core business decline and rising costs from a captive supplier.
Which brings us to our final provocative thought for you to consider. Management got $10 million from selling off those old patch pump assets, and they're paying down debt aggressively. The question is, will that capital and that renewed focus on the GLP-1 option give them enough bandwidth, both financial and mental, to actually pivot before their core injection business erodes too much to overcome?
The clock is absolutely ticking, and you can bet the market is going to be watching that Q1 2026 revenue line very, very closely.
We'll keep tracking that story here on The Deep Dive. Thanks for joining us. We'll see you in the next one.